Last week, I went out to have lunch with a friend and we talked about many topics. One of the interesting topics is, of course, Tesla. And I believe that whenever you talk about Tesla with a friend, for sure you will hear people say, oh, Tesla is overvalued, da da da. In today's video, I'm going to take a detailed look at Tesla to determine whether this company is overvalued or not. Let's dive in. When we talk about the valuation of a company, two valuation metrics that is very popular is price over earning and price over book. You might ask, why price over earning? Why should we relate a valuation of a company to its earning? This should be quite straightforward because when we own a company, we are expecting that this company will continue to generate earnings in the future years. And one way to value a company is basically to discount all these future earnings or cash flow back to the present time. The second valuation metric is price over sales. Sales is very important because without sales, it is impossible for a company to make any money. And the relationship between sales and earning is that basically sales is the amount that company collect, whereas earnings is after you deduct all the expenses. And one thing to note is that when we look at these valuation metrics, they are usually based on a single time point. And if we look at the price over earning, the earning refers to the totals of earning in the past 12 months. A similar metric is forward PE, which is the today's price divided by the forward earning or the projected earning in the next 12 months. So a valuation of a company is a complex topic. Definitely it cannot be simplified to just a couple of ratios like price over earning, price over sales, or price over book. The reason is that when we look at a company, we should look at the projected earnings in the future. And the projected earnings will depend on the growth rate of that company. So it is common to see that company with a very high growth rate will have a much higher price over earning or price over sales ratio. Another thing to watch out is that price over sales will highly dependent on the industry of the company. Some company, for example, like supermarket, they will have very high revenues, but then the profit margin of that company is very low. So for those companies, if we look at the price over sales, usually you will see a very low ratio. I think this should be enough for an introduction. Let's look at price over earning and price over sales for some of the companies. Before that, let me just quickly walk through the source of the data. So for market cap information, I'm using the resource from this website. It's called the Docs of the Dow. It basically lists down the companies with the top market capitalization. For revenues and net income, I'm using the data from the Macro Trends website. You just need to go to the website and look at the revenue here. And we can see that the trailing 12 months revenue is shown in the chart here. I'm looking at Tesla now. The revenues in the past 12 months is 28 billions. So this is the quarterly revenues. And then the bottom chart here shows the growth. So in terms of growth rate, I'm using the year-on-year growth, which is comparing the revenue for the latest quarter versus 1 year ago. So for Tesla, the growth rate is 39%. So for net income, you just have to click on the net income and then just scroll down. So for Tesla, you can see that the profit just turned positive 2 quarters ago. Let's take a look at the comparison of a few companies. So the first chart that I'm showing here is market cap versus revenue. This is essentially same as the price over sales. So for company with low price over sales ratio, they will belongs to this region here. And those with very high price over sales, they will appear here. So this line here, the red line, showing the price over sales of 6. So you can see that for revenue here, let's say 400 billions, correspond to the market cap of 2.4 trillion. So of course, we can see that company like JP Morgan and Berkshire, these are the companies with very high volume of revenues, but their market cap is not as high. For Amazon, because this is a retail business, so it is also quite reasonable that they have a somewhat lower price over sales. And you can see that for Tesla, even though the sales is quite low at about 28 billion, but their market cap is more than 800 billions. And from this metrics, it seems that Tesla have a high valuation. Let's move on. The second chart is showing the market cap versus the net income. This is equivalent to PE ratio. So for this chart, it shows that the relationship between the earning of a company versus their market cap is more linear. You can see that for companies, for example, like Facebook, Google, Microsoft, Apple, it almost forms a straight line here. This just shows that the company's earnings has a positive correlations to their market cap. So the red line that I'm plotting here, this is the PE of 30. So for these big 4 companies, I think their PE is somewhat around 30 to 40. So if you look at the PE of Amazon, it is definitely quite high, about close to 100 here. And you can see that Tesla is again an outlier. The PE ratio for Tesla is more than 1,000. So by just looking at these two ratios, some people will say Tesla is overvalued because the price over sales and price over earning is very high. Some might say that Tesla is a company with very high growth rate, and because they are still growing now, they are not able to generate as much of earning. So the high PE is justified. I think there's some truth in it because usually company with a very high growth rate will have a high PE. But let's compare the growth rate of Tesla versus other high growth companies. So on the third chart, I'm basically showing the growth rate. This is the year-on-year growth rate versus the PE ratio. So on this chart, you can see that the PE of most of the companies that we are looking at is below 200. Tesla is at 1,000, close to 1,600. And in terms of growth rate, definitely Tesla has very high growth rate, close to 40%. But this is the growth rate that is equivalent to Alibaba and also Amazon. And for NVIDIA, the growth rate is even higher at between, let's say, 55 to 60%. Even though NVIDIA have a much higher growth rate compared to Tesla, but you don't see their price over earning that is as high as 1,500. And of course, for a company that is either not making money or at break even, the price over earning ratio is definitely skewed. So I think one way to look at it is just forget about the earnings. We just look at the sales. So similar picture here. This is the price over sales versus the growth rate. You can see that NVIDIA definitely has a higher price over sales, but still below Tesla. And Alibaba and Amazon, these are the company with very high growth rate, but with somewhat reasonable price over sales ratio. But bear in mind that these two are retail companies, so lower price over sales is also quite common. So in this table here, I'm just providing the data for your reference, but I already shared the source of the data. So if you are interested to get this kind of information, you can just look at it in the internet. So what conclusion can we draw from this analysis? In my personal opinion, I definitely believe that Tesla is somewhat overvalued now. And in the market, there's a lot of fear of missing out. People keep buying the share price without looking at the valuation. And it is not easy to convince a Tesla owners that this company is overvalued, because when they look at their brokerage account, what they can see is there's a lot of earnings since they bought. So if you're bullish on Tesla, I think it is fine to own the company, especially given that the sales will continue to grow at least in the next few years. However, my personal recommendation is that don't over allocate to just one single company, especially if you have a very large portfolio. Please do your own due diligence before you over allocate into any company. That's all for this episode. Feel free to discuss in Telegram group. See you.